Welcome. I'm Jeff Turnahoy, head of Lipper Americas Research, and I'm joined today by Sandy McIntyre, President and Chief Executive Officer of Sentry Investments. Welcome, Sandy.
Well, it's a pleasure to be here, Jeff.
Well, Sandy, let's start off. Sentry has won Lipper's Best Equity Funds Group Award for 2 years in a row now. What is it about Sentry's success that has led it to be so consistent?
I think it's because we consciously manage risk in our portfolios. It's an interesting sort of congruence of you measure the fund family's results using a methodology that neatly meshes with how we measure the performance and the risks taken by our portfolio managers.
Sentry Investments places a lot of emphasis on return on assets, return on capital, instead of pure growth. Why is that your strategy?
We find that companies that generate a decent and rising return on assets, decent and rising return on capital, show that they're good allocators of capital and that they will be able to grow the free cash flow that's necessary to engage in shareholder-friendly behavior, share buybacks, dividends, interest payments, and so forth. When we own a company, we're looking for rational growth rates. We look full cycle. We try to analyze for the variability across a cycle. Indeed, as you get into late cycle, we will be stress testing business models to see if we can create a situation that makes us uncomfortable as you go into the natural cyclical downturn. This is all in an attempt to generate real economy returns while mitigating real economy risk as the economic cycle advances.
Okay, so is it more of a top-down or bottom-up approach?
It's very much bottom-up by company, individual models looking at individual companies. Very balance sheet driven, very liquidity driven, and with a top-down overlay saying, look at your companies in the context of this economic outcome. This impact on final sales.
Okay, so when you measure the success of your managers, how do you evaluate them?
We start with looking at their risk-adjusted returns on a 1-year and a 3-year basis. It's weighted more towards the 3-year number than the 1-year number. What we're trying to avoid is risk-seeking behavior in a short period to amplify current period returns.
Okay.
One of the other aspects of measurement that I'm quite intrigued with is our managers all co-invest in the funds. So it's not an agent taking risk with somebody else's capital. It's a co-investor managing their own capital along with the client's capital.
Right. So they have to eat their own cooking.
Very much so.
Okay. So let's talk about volatility. Do you think the volatility we've seen in the last few years is likely to continue, or where do you think it's going?
The volatility I see is a bit of an artifact of two inputs.
Okay.
The first input is an increased emphasis on trading activity. People become more and more short-term in their time horizons. The other is that computers have become an increasingly large share of daily trading volumes. Program trading, indexing, all these pieces.
Sure.
We find actually that our portfolios have a very low correlation with index returns, and our volatility has a low correlation with index volatility because we don't own the main components of the index.
Right.
If you look historically, the volatility really began to increase in the mid-'80s, and you're too young to remember this, but October 19th, 1987, down, I think it was 19% on the day, computer-driven.
Right.
And that is a earthquake or a shock of volatility that had aftershocks over a period of time. We had another major volatility earthquake in October of 2008 with a cone of descending volatility, an aftershock with a flash crash in May 10, and a third aftershock with the big margin call in August of 2011.
Mm-hmm.
After these volatility peaks, you get descending volatility. You usually put in a bottom 2-3 months after the peak of volatility.
Okay.
You wash out the weak hands,
Mm-hmm.
and then you get a fundamentally driven market move. And regardless of what people say about the U.S. economy, there are signs of healing.
Uh-huh.
And very quietly, S&P 500 is putting in record earnings, and I don't see the media talking about it.
That's very true. Now, one thing that you guys do like to talk about is volatility. Now, you seem to have a keen interest in risk. What sort of investor is most interested in these Sentry products?
I'll give you a bit of our background. I actually started in this industry as a trust administrator, trust officer doing estate work back in the 1970s. I became a retail stockbroker in the early 80s and then went on to managing as an investment counselor, primarily a retail book.
Okay.
What I found was that young people didn't have a lot of capital, so they really weren't a client that I was prepared to go after.
Okay.
The institutions were already well served, but there was a whole world out there of middle class, upper middle class, people between 50 and 80 who showed a very common theme in their account opening forms.
Okay.
It was, I want preservation of capital, long-term growth in that capital, and an income stream from the capital.
All right.
So usually when I was sitting down with the couple, one of the couple would either turn to me and say, don't lose my money, or I don't like volatility.
Mm-hmm.
We then go on and say, okay, if we're managing a portfolio, what are the characteristics that they like, and build the portfolio using a building blocks that achieve those characteristics.
Oh, right.
Now, I say I'm manufacturing for an older target audience. I would say that what we are doing is very fundamental to investing and is suited to any investor.
Okay.
Somebody who loves volatility, we're the wrong shop. But somebody who wants understandable and reason-based returns, I think should be looking to our style of management.
Excellent. Well, thank you again for joining me today, Sandy. Appreciate your time.
Okay, thanks, Jeff.
On behalf of Sentry Investments and Lipper, I'm Jeff Turnahoy. Thank you.